Diversification Part 2. This is a follow-up to the last video we did, but the only difference is now we're not talking about investments, we're going to be talking about tax planning with your investments. So when we think about diversification, as you learned in the last video, we're not talking about putting all your eggs in one basket. And obviously everyone knows that's not what you should do. You should have a diversification when it comes to investments. Now, when it comes to how your investments are taxed, many people think they should be diversified, but not a lot of people are. Typically what we see is most people have the majority of their money in tax-deferred vehicles. If you have the majority of your money in tax-deferred vehicles and there's $30 trillion here over that, and there's less than $1 trillion in tax-free vehicles, do you think you're diversified? Do you think we're diversified as a whole? Probably not. So what we're typically trying to encourage people to have is more diversification when it comes to taxes on your vehicles. Let's maybe look to have more of a balance so we can decide what is the best place to take from in retirement. And so this is something more advanced that we need to consider. Think about it this way. You're in retirement, you have $1 million in your 401k, and you need $40,000 a year to live on. What happens if you have all your money in that tax-deferred investment we just talked about and you need $40,000? Got to pay taxes, right? My question is, how much in taxes are you going to have to pay? Well, one, we don't know because we don't know what tax rates are going to be, but also you have to consider that not only are you going to be paying federal income taxes, not only are you going to be paying potentially state taxes depending on where you live, local taxes, but you're also going to probably have to pay now Social Security taxes. Remember, Social Security is not taxable to everyone, only to a certain amount that have a higher income. So if you're taking out $40,000, you may force yourself to have Social Security close to fully taxable or fully taxable at that point when we may not need to have that happen or may not have to have that happen. And the way we don't have that happen is, what if instead of we took out $40,000 from our IRA, what if we had some tax-free vehicles that maybe we took 20 from here and 20,000 from here? Well, now maybe we're able to keep our income from not being taxed by Social Security or just a very little. And so if we have that diversification, we can decide which investment vehicle to pull out from to live that retirement that we're looking for. The other consideration here is we don't know what future tax rates are. I'm going to expect they're going to go up. Most experts, most other people expect them to go up. But tax rates are written in pencil. They could go down for all that I know. And so I want to have the flexibility, knowing that if you're retired or close to retirement, you're going to have 20, 30 years left to live. And if that's the case, then we need to make sure that we have the balance to pull out of whichever account we want at whatever time. Let's look back at history to give us a guide. If you go back to the 70s or the 1981, for example, the highest tax bracket was 69%. Well, if tax rates are that high and you have these two options, are you going to take from your tax-free vehicle or your tax-deferred if you need money? I'm taking from my tax-free. I don't want to pay a 70% tax rate. Well, if you look today, the highest tax bracket is 37%. Much lower, right? Taxes are on sale right now. Which vehicle would you rather take out of now? Tax-free or tax-deferred? Probably a better decision to take it out of tax-deferred. And so since we don't know what tax rates are going to be, and they've been all over the place in the past and they're probably going to be in the future, having this balance helps us there. But also allows us to play the game, to be able to allow ourselves to see what is our income and how can we stay under that standard deduction, how can we keep our provisional income lower when it comes to Social Security taxes, and how can we keep our income under the Medicare premium tiers, how can we keep capital gains tax-free, and be able to have that flexibility of where we take out money. So tax-deferred, tax-free, we've talked about in depth. The other consideration is your taxable investment. Those are those capital gain type investments that we also have to consider in this conversation. If you can strategically implement these types of strategies correctly and have a good balance among these three taxable buckets, you're going to lead to living a lot less tax retirement or potentially a tax-free retirement. And I often ask people, how would you feel if you never had to pay a tax ever again in your life? Well, it's potentially possible if you do the right kind of planning.